Good afternoon, everybody. Hope you're all well. Peter Avail here in Grant Thornton. Thanks for attending today's webinar. Stormy conditions out there. It's okay in Dublin. Hopefully it's okay where you are. I know, talking to our colleagues in Cork, Limerick and Longford, there's been a fair bit of damage, so hopefully not too bad where you are. Today's webinar is in relation to some of the tax relieving measures that have come out in the last while. So hopefully there is a bit of good news for some people. It's obviously been a very difficult time for businesses and individuals, but there's been a general acknowledgement that government supports have at least gone some way to alleviating some of the financial pressures that people might otherwise have been under. And indeed, part of those measures have involved tax relief, and essentially tax reliefs that have helped boost cash flow. And they've generally come along in a piecemeal manner from at the onset of COVID, with a further raft of measures in July that you may have heard about. So the purpose of today's webinar is to go through those relieving provisions and how they can be best accessed. And there are also a couple of things just to watch out for, which we'll flag. But generally, most of the announcements have been positive and indeed helpful for taxpayers, which is good. And in fact, I think it's fair to say that the mood music and revenue generally since March has been an understanding of the position of taxpayers. And again, that's helpful. And a lot of their usual revenue audit activity has been put on hold for the moment. We do encourage questions, as is the norm with webinars, and there is a chat function at the bottom of your screen, which please do access. We'll do our best to get through as many of those questions as we can. And if we can't, look, we'll try and address them later. Speakers today are me, Peter Avail, Sarah Meredith, and Kim Doyle. Sarah's going to take us through the main item, which is in relation to accelerating loss relief claims for companies, and then some other related matters. Kim will go through a new provision in the July package in relation to corporate tax liabilities and the ability to a lower interest rate and some outstanding liabilities. And then I'll wrap up very briefly with some other topical matters. So without further ado, I will hand over to Sarah.
Thanks, Peter. Good morning, all. So as Peter alluded to, the first measure I'm going to cover is probably the bulk of the presentation. It pertains to the loss relief provision, so a new provision that has been introduced to essentially tap into losses generated in the back of COVID in an expedited manner. So as part of the July stimulus package, the government introduced a temporary acceleration of loss relief for tax compliant companies. So the implications, the objective is really to reduce the tax payable in FY19 tax returns on the back of this loss relief. Thanks, Ian. So the rationale behind the relief is really to provide a cash flow benefit for companies. So I think it's useful just to start and look at the existing provisions before this new measure came in. So for example, if a company generated losses in 2020, it would have to file its tax return, which would typically be in September 2021, and it would then carry those losses back to the preceding period. So there's a time lag before you can actually access them. Whereas under this new provision, there's now a cash flow benefit whereby these companies generating losses on the back of COVID can actually carry them back to the preceding period when that preceding period's tax return, being 2019, is being filed with revenue, which would tip for December year ends be the 23rd of September this year. In terms of, just in high level terms, the losses that are captured under the new provisions pertain to losses accruing between the 1st of March 2020 and the 31st of December 2020. So yeah, the result of the relief is essentially an early access to these 2020 losses. So the way the relief has come in, a new provision has been inserted into the tax legislation. It's section 396D into the Taxes Act, which provides for this acceleration of the losses, whereby relief is available for companies which incur or incurred trading losses in that 10-month period I alluded to. And essentially companies are permitted to make an interim claim to carry back a proportion of the losses to the immediately preceding accounting period under the normal rules. So the only real difference is kind of the expedited access to the losses. So it should benefit cash flows in that you don't have to pay your tax and then when next year's tax return is filed, throw the losses back, but rather you can avail of them now and reduce your tax payable immediately. So in terms of what the relief is, so what the companies are required to make an interim claim for these losses. So companies carry back the estimated trading losses incurred in a specified accounting period, and I'll define that in a later slide, against the profits of the immediately preceding accounting period. And the way it works is the normal loss provisions apply. So, you know, you carry your trading losses back against your trading profits in the preceding period on a one-for-one basis, and all the other rules that apply to the loss provisions equally apply in this scenario. So as I mentioned, really from a practical perspective, you don't need to wait until the end of an accounting period when the losses arise to get the benefit of them, but rather you tap into them now when you're filing your period with your profits, and you're carrying the losses from the COVID period back into that tax return. So in terms of which losses actually fall into the new regime, it's really targeting two types of losses. The first is a relevant trading loss, so that's a normal trading loss being derived from normal trading activities. And the interim claim, you can carry back up to 50% of that loss. And that 50% also applies for non-relevant trading losses, so they're losses deriving from accepted trade. So that would be activities such as dealing in or developing property, and it's where the profits are taxable 25%. You carry the losses, they're also kind of value based at 25%, and they shelter profits at 25% in a one-for-one basis as well. And one important thing to note, while this provision, it caps the losses that can be carried back to 50%, under the normal loss provisions, you do have the ability to carry back 100% of the losses. So essentially this new relief is allowing you to carry back half and claim them now when you're filing, say, your 2019 tax return. And the balance of the 50% of the amount you haven't claimed will continue to be available, but not in this expedited manner. So you would need to wait until your loss period is filed with revenue, and then you would access the balance of losses that you haven't availed of. So one of the next tests, just in the context of this relief, it's important to look at the specified accounting period. I mean, which losses fall into the new relief and the new provisions. So it's any accounting period whereby the company carries on a trade, and it falls into the time window of the 1st of March 2020, and it ends on the 31st of December 2020. So there's a 10-month window of losses that fall within the new section 396D. So for December year ends, it's fairly straightforward. You have 10 months of losses that could be availed of under the regime. For different year ends, you would need to map it out. So say, for example, for a June year end, you would have 4 months falling within the year end of June 2020, and then you'd have the other 10 months falling within the year ended 30 June 2021. So you would need to map out what makes the most sense from a tax perspective in terms of which period you should look at in terms of throwing the losses back. And it's unlikely that you wouldn't be able to avail of loss carrybacks for both periods, because you need profits in the preceding period. So this is just an example. So if we have a company with 31 December, as I mentioned earlier, you have the full benefit of the 10 months of losses that falls within this accelerated loss relief. Whereas if you have a period 30 June, your 30 June 2020 and 30 June 21 period, they both are regarded as specified periods under the new provisions, because they fall into that 10-month window. So you would need to kind of do a mapping exercise, see when the losses accrue and see what benefit both periods could generate on the back of carrying back losses. So the next key consideration associated with the relief is the timing of the interim claim. When can companies actually make it? So we know what period the losses span or can cover. So you look at the beginning of the specified accounting period, and then the claim, it can be no earlier than the end of the period plus 4 months from the beginning of the specified accounting period. So for your traditional December year end, The earliest you could make it is the 1st of May 2020, and the latest you can make it is then 5 months after the end of your specified accounting period, which would be the 31st of May 2021. So for that 2020 accounting period, if you haven't made your claim for this 3960 relief by the 31st of May 2021, you just fall within the normal kind of provisions, and you would carry back 100% of the losses once your 2020 tax return has been filed. So Revenue have set out kind of a list of eligibility criteria in terms of what companies need to do to avail of the relief. So a declaration needs to be made that should be included in the corporate tax return. So just setting out a bit of context that the company is opting to avail of this Section 3960 relief. The tax relief, it is geared at tax compliant taxpayers. So the companies should have met all their obligations in terms of tax returns being filed and payment of taxes being up to date. And the third kind of element around the eligibility is around supporting documentation. So the company must prepare and retain records, kind of evidencing the basis on which it's computed the relief. So the company should have really robust documentation just supporting the positions being taken and the basis upon which it is claiming the expedited loss relief. So I suppose when we looked at the time spans as to when companies can claim the relief, and there is the ability to claim the relief before your financial year has actually ended. So what that means in practice is you could potentially claim loss relief based on best estimates, but there could be fluctuations between when the claim is made and the year end and kind of final results. So the legislation does cater for those kind of scenarios. There's an ability to revise interim claims as the specified accounting period progresses. So say, for example, you've claimed 100,000 of losses because that's what you think you're going to generate as a loss in the 2020 period. And actually you have kind of a bounce towards the end of the year and your losses end up being a little bit lower. What Revenue say is as soon as the taxpayer becomes aware of the reduced loss, you should go back and amend the interim claim you have made as soon as possible. And I'll come on to the interest in a moment. So yeah, if it comes to the company's attention that 50% of the estimated loss is lower than the amount that has been claimed, the taxpayer or the company must reduce the claim by the excess claimed without delay. There is potential interest on any overclaims at 8% per annum, but the timing of the interest, it really depends whether or not it was deliberate or careless. So if a taxpayer can prove that the claim wasn't kind of overclaimed or wasn't a careless claim, the interest should really only accrue from the date the claim is reduced until the date the company actually repays the tax. So I suppose it is important on the documentation side, again, the companies kind of show that best endeavours are being made in terms of when the claims have been made and revised to avoid any potential imposition of interest by Revenue. So this slide, it really just sets out the order of events for submitting a claim for relevant trading losses, and these are losses relating to kind of normal 12.5% trading activities. So the CT1 for the preceding accounting period must be filed. So let's say in this case, the 2019 corporate tax return needs to be filed on ROS. And after that has been done, a claim can then be made by amending that corporate tax return for 50% of the losses from the subsequent period are being carried back. And again, that's done through the CT1, but interestingly, it can't be done at the same time. There is a 24 or a day kind of window. So you claim your tax, you file your tax return without the relief, and then a day after you avail of this Section 3960 interim loss relief, and you pull in the 50% of your losses. And you're also obliged to tell Revenue that the claim is being made under Section 3960 through the additional notes to ROD's facility. And we have an example just set out in Appendix 2. It's slightly different when you're submitting a claim for non-relevant trading losses. And these are losses on accepted activities. So things like developing land where the appropriate tax rate is 25% as opposed to 12.5%. So the CT1 actually does facilitate to be made on a contemporaneous basis. You don't need the 1 day or the 24-hour window. So what you do in this instance is you calculate 50% of your non-relevant trading loss for the period, and you then go into your CT1, into the accepted trade profits, and reduce those by the loss that's available for, let's stick with the 2019 period, and that the losses then pop up for the accounting period on the CT1, so you're essentially getting the relief as the tax return is being filed. So we then just move on to finalising a claim. So once the specified accounting period has ended, it's really important to go back and just quantify what the actual trading loss for the tax accounting period was. Did that differ from 50% of the loss that was claimed? And if it did, you need to go back and amend the corporate tax return for the correct amount of the loss. And also just to note that any claim for the carryback of any losses you haven't claimed, so for example the remaining 50%, they do need to be claimed within a 2-year window from the end of the accounting period, so it is important not to miss those. So I just have a few examples I'm going to go through quickly, just to put it all into context and just to see how it plays out from a practical perspective. So in this first example, we have a company, Outdoor Events Limited. It is the 31 December year end and profits of 100,000, so tax 12.5%, giving a charge of 12,500 euros. It anticipates that because of COVID, it's going to have relevant trading losses of 60,000 in the FY20 period. It can make an interim claim under this new provision to carry back 50% of the loss, so 50% of the 60,000, against its FY19 profits on the basis that those profits did accrue in that specified period, in particular from the 1st of March to the end of December. So what does that mean? It means that the 19 trading profits that are taxable are reduced down by 30,000 to 70,000, with the tax being reduced down to 8,750. So you're seeing a real difference, or a real saving of 3,750. Just moving on. So again, if it transpires that the estimate was incorrect and you carry out a subsequent review, and actually in light of how the economy has evolved, the relevant trading losses are actually due to be lower, they're going to be 80,000 for the 2020 period. What the company is obliged to do in that situation is to make a revised interim claim and to carry back, so you look at what the loss you carry back should be. So now we're saying it should be 50% of the 80,000. 40,000, apologies, the loss actually increased in this scenario. So you're actually driving your tax charge down even further to 7,500. So in this scenario, you're actually tapping into an enhanced refund. So the claim, it should be finalised after the end of the accounting period, once you've kind of bedded down your actual loss figures. Just moving on to the next example, we have a company here, Cinema Limited. It has a 31 July year end. So as I mentioned earlier, because this spans the 10-month period, you have two accounting periods that actually fall within the COVID loss window. You have 31 July 2020 and 31 July 2021. The profits for FY20 are 60,000, and you have tax at 12.5%, giving you 7,500 euros. It then anticipates it's actually going to generate a loss in the subsequent period of 50,000. The earliest date it can make the claim is the 1st of December. So it can carry back 50% of the loss to the preceding period. So again, you're driving your tax charge down and generating a tax saving of 3,125 versus the original liability of 7,500 euros. And again, in June 2021, so as you approach year end, on a review of the trading position, the company has now estimated that its losses are actually going to be close to 30,000. So again, that revision is needed. So it needs to go, but the company needs to go back and amend its interim claim as soon as possible. So what happens in this scenario when you run through all the numbers, the resulting tax liability is now €5,625 for the 2020 period. That in this case, we're actually seeing an increase in the corporate tax liability because of the change in losses. There's only interest applicable on the revised claim if the company can prove it wasn't deliberate or careless in making the initial claim. The interest cap would only run from the date the claim is actually revised with revenue. And the last example here is just a company, Wholesale Limited, and this company has trading profits and rental profits that will be liable to tax 25%. So in aggregate, when you work it all out, the tax charge is $25,000 for this 2019 period. It then comes to look at the next period, the 2020 period, and it is a trading loss of $300,000. So it is entitled to tap into this accelerated loss relief to claim half of the 2020 loss against its 2019 profits. And again, when you map it all out, the corporate tax liability is essentially you're tapping into relief of $18,750 versus so your tax when you claim this relief is $6,000, whereas if you hadn't been in a position to claim this accelerated loss relief, you would have had a tax payable of $25,000, and you could only ever have reduced this when the 2020 tax return was filed. So I suppose in a nutshell, really, I think what's the message? I think taxpayers, where they're in a tax payable position for 2019, but they have seen significant losses in 2020, I think this tax relief and the appropriateness of claiming it really does need to be considered. And I think in looking as to which clients or taxpayers are going to claim it, there'll be a requirement to do a cost benefit analysis, and it will likely be done on a case-by-case basis. Just some of the important things to know where companies do claim it. I think monitoring the loss position is really important, particularly where you're claiming the loss relief based on your forecasts and budgeted numbers, and there might be swings and adjustments as you come up to year end. I think the other message to clients that do claim it is it's really important to have underlying documentation just to support the relief that's been claimed, and to make sure that any claim is robust, and if revenue were to come in and look at it, that there is kind of a good rationale and basis for availing of it. I think the other thing to note is for taxpayers, it is capped at 50% of the losses. So there might be a further incentive to file early for the 2020 tax returns to tap into the additional 50% of losses. So that's really it in a nutshell. And if you have any questions on it, you can put them up through the Q&A facility. I just have three other provisions that I'm going to touch on that are relevant from a corporate tax perspective and are kind of COVID related as well. So the first, there's two changes really around the R&D tax credit. So the first change is kind of, again, in the same vein, there's expedited refunds available where clients are in a tax repayable position on the back of R&D tax credits being claimed. So what Revenue have said is that essentially taxpayers can now tap into cash refunds that have been generated by R&D tax credits being claimed as part of the FY19 tax return. So typically that would comprise the 33% from FY17, the second instalment of the FY18 R&D tax credit, and then 33% of the R&D tax credit being claimed in respect of 2019. In the past, Revenue would never pay them out until after the filing deadline, and they required IXBRL accounts to be filed. Whereas now they're saying actually you don't need to wait until the filing deadline, and you don't need to be IXBRL accounts filed. So once taxpayers with these R&D tax credits file early, they should be entitled to the cash being paid out. Now Revenue still may make appropriate tax, so they may issue aspect queries or 23 questions just around the robustness of the R&D tax credit claim. So that hasn't changed, but they are committed to trying to issue the cash as soon as possible, subject to the claim being in line with Revenue guidance and legislation. The other important change around the R&D tax credit is there were new guidelines issued from Revenue around the R&D tax credit. And essentially, the new guidelines issued in July 2020. So in the past, rental costs would have formed part of R&D tax credits being made. But now they're actually they've been specifically carved out from R&D tax credit claims. So the rule of thumb is any R&D tax credits being claimed after the date this new guidance published should not include rental costs on the back of this new revenue guidance. Just to note, there is lobbying and there's various submissions being made to the Department of Finance because it is a very fundamental shift to the R&D tax credit regime. But just, I suppose, the key recommendations for clients that are claiming the R&D tax credit is to prepare your R&D tax credit reports early and expedite the finalisation of the Form CT1 and the tax comp just to try and access the cash as soon as possible, and just make sure that the claims don't include rental costs in the absence of any change in revenue guidance or legislation. Now moving on to this slide, just on PSWT. So just by way of recap, PSWT essentially it's a 20% withholding tax deducted by state and semi-state bodies regarding professional services. And Revenue have come out with a COVID-related measure essentially to streamline and expedite PSWT refunds. So what Revenue have said is where F45s, which are the underlying certificates or statements, where they can't be issued due to COVID, a written statement issued by the accountable person will be accepted. So taxpayers now have the ability to go into the My Inquiries Revenue platform and attach the F45s and F50 and claim any interim PSWT refunds they may be entitled to. Again, the documentation is important, so taxpayers should retain the original docs related to PSWT. And Revenue said if they do come looking for those certificates at a later date, they may withdraw the refund that they had provided to taxpayers. So, but there is, I suppose, for taxpayers that typically avail of interim PSWT refunds, the process is a little bit easier and more streamlined. So it's definitely something worth looking at. And just my last area is just around closed company provisions. And again, it's a COVID-related relaxation. So just moving on to the next slide. So for companies within that are regarded as closed companies, so essentially where they're controlled by 5 or fewer participators, where those companies earn either professional services income or investment income, in the past, to avoid a surcharge being imposed, distribution to be made within 18 months of the end of the accounting period. Revenue have extended this 18-month window. They provided taxpayers with an additional 9 months. So essentially it's giving taxpayers 2 years from the end of the accounting period to make a distribution to avoid a surcharge being imposed. But it is important just to apply to Revenue to avail of that extension. So again, something worth looking at if companies just don't have the cash to pay dividends up to the shareholders, there is the ability to push it out. That's all on my side for the moment. And I will hand over to Kim now, who's going to talk about the reduced interest rate available to taxpayers.
Over the next couple of minutes, I want to provide you with some key information on a new reduced interest rate on outstanding tax debts that's now in our Irish tax code. So this reduced interest rate was first announced as part of the government's July job stimulus, and it was subsequently legislated for. So the reduced interest rate is of 3%, and it essentially applies to those unpaid tax debts that cannot be warehoused. Now, by warehoused, I mean debts that are not available or allowed to be part of the debt warehousing scheme. And just very briefly, the debt warehousing scheme applies to PAYE and VAT COVID-related debts only, tax debts only. So essentially what you have is a reduced interest rate of 3% that can apply to all other tax heads or all non-COVID related tax heads. So the rate as you'll see there on your screen, is a reduced rate of 3%. Now, in comparison to what? Well, the current standard rate on unpaid corporation tax is 8%. So I suppose it represents a reduction of 5%. Now, this measure was introduced as a way of providing vital support to struggling businesses and companies that cannot pay their tax liabilities, and it was certainly very much promoted by government as part of all the announcements and media around the July job stimulus. The measure, as I mentioned, is legislated for, so it's currently in our Irish tax code and it's applicable from the 1st of August 2020. So generally, I suppose the key information that I want you to take away from today on this measure is that, as I mentioned, it applies to unpaid tax debts. So it applies to declared, but those tax debts that cannot be paid. So by declared, generally what that means is, you've notified revenue and they're filed by way of the relevant tax return. It applies to COVID, non-COVID related and COVID. So essentially those debts that cannot fall within the debt warehousing scheme that I just mentioned a few moments ago. Now, if a company wishes to avail of the reduced rate of 3%, I suppose the key or the main course of action that needs to be taken must be taken by the 30th of September 2020, so just in a little over a month's time. And what the action is you must go to revenue and declare your tax liabilities, and then go to revenue and enter into what's known as a phased payment arrangement. Now, a phased payment arrangement is by no means new, and some of you may already be familiar with what is also commonly known as a PPA. So there is already a facility in place for taxpayers who have difficulty in paying their tax debts to enter into this PPA with revenue. So to avail of the reduced interest rate of 3%, you must enter into or agree a PPA with revenue, and you can see the deadline there of 30th of September, so that is key. Also, it is worth noting that if there are existing PPAs in place, so if the company is already entering into an arrangement with revenue to pay any historic tax liabilities, they can also avail of the 3% interest rate. However, the 3% interest rate is applicable only from the 1st of August 2020, so that is the date that the legislation was passed, and so that's the applicable date for this 3%. So the higher rate, for example, with corporation tax, 8% will apply up until the 1st of August, and thereafter the 3% will apply to the remainder. I'll go through this in a little bit more detail in a moment. In terms of the scheme then, one of the, I suppose, key points to be aware of is that it has a significant impact on your tax clearance and your eligibility for other measures that were introduced as part of the July job stimulus, and I suppose any other measures in the Irish tax code. So if you have not entered into a PPA, so that's a phased payment arrangement, just as a reminder, with revenue in respect of unpaid tax debts, you essentially are not fully tax compliant, and therefore you cannot obtain a valid tax clearance certificate. However, if you are part of the debt warehousing scheme or enter into a PPA with revenue, you will still be able to avail of a tax clearance, assuming all other requirements in the Irish tax code are fully satisfied. If you don't have a tax clearance, it will impact on eligibility for other measures, such as, for example, per the slide there, the employment wage subsidy scheme, which may be of interest to some employers, and also the measure that Sarah just spoke on a few moments ago on the accelerated loss relief. And then there's other measures, as I mentioned, in the Irish tax code. So I suppose a PPA is important from your tax clearance perspective, but also to avail of our 3% interest rate that's now in the Irish tax code. So if we look at new PPAs, so this is where you are going into enter into an arrangement with revenue in respect of unpaid tax liabilities that are declared. So there's difficulty in making those tax payments. So for new PPAs, I suppose just briefly in terms of the steps, the key steps are you must enter into the PPA before 30th of September. So 30th of September, that is the deadline date. Okay, and as I've already mentioned, it's for those tax debts that don't fall within the debt warehousing scheme. What will happen then is the interest will be calculated at the standard or the current rate in the Irish tax system, which is 8% for corporation tax liabilities. Now, for other tax liabilities, it can be, it can be higher, it can be up to 11.75%, but just for corporation tax, it's 8%. So from the date that the tax was due, so in respect of when the liability was due, it would be 8% up until the date you enter into the agreement. Then what would happen then, so if you enter into an agreement, for example, say with revenue, and it's effective from the 1st of September 2020, so from the 1st September 2020, the reduced 3% interest rate will apply for the remainder of whatever arrangement you've come to with revenue. As I mentioned a few moments ago, that this reduced rate of interest of 3% is also available in respect of current existing phase payment arrangements that are in place with revenue. So the way these will work is that from the 1st of August 2020 being the date that this measure came into law, the projected interest rate that was in terms of the PPA will now be reduced and recalculated at the 3% rate. And the 3% rate will apply for the remainder of the tax debt. So the standard 8% rate for corporation tax liabilities will still apply up until the 1st of August 2020. This reduction, according to revenue, is the reduction in the interest rate down to 3% is expected to be made automatically by revenue. At this stage, I understand that revenue will be in contact with those that are already in existing PPAs, so you may have already received contact from revenue in relation to this, and then the 3% will apply thereafter. But I suppose key in all this is the 1st of August 2020 is the date for existing PPAs, and for any new PPAs, the arrangement must be entered into by the 30th September 2020. So that's generally how the terms of the scheme and the key dates that we need to be aware of. But how to avail of the reduced interest rate of 3%? Well, in terms of any entering into any PPA with revenue, it all must be done via the Revenue Online service. So there's no significant change there. As I mentioned at the outset, this PPA is something that has been in place a period of time now with the Collector General, whereby if you cannot pay your tax debts, so you do so via the Revenue Online service. Now, there's been a few enhancements made to benefit those who are looking to avail of the reduced interest rate of 3%. And when I say enhancements and benefits, I mean by the system or the process has been somewhat simplified to some extent in terms of quickening it up. But I suppose we have to see as that moves on and as this is taken up before the 30th of September, how that will work in reality. I suppose the key then is just to contact us if you wish to learn more. What my aim was to highlight the key points and the key information points on the reduced rate of interest. Also, we have a webinar that's scheduled for the 10th of September 2020, which will cover both the debt warehousing scheme and this reduced rate of interest. So you'll hear lots more on that webinar. So keep an eye out. The invitation will be sent out over the coming days. So I'll just pass you to Peter now. Thanks very much.
Thank you, Kim. Thank you, Sarah. And it's clear, look, there were very significant cash flow savings there, so I think it's definitely worth, particularly around the losses, having a look at what the position for 2020 might be. So the slide, we've 2 slides left, so nearly there. I'm just going to touch briefly on tax residence, and what this is about is, I suppose, given COVID and the impact on travel movements of many individuals, it would, in the absence of any relieving provisions, it could trigger quite a number of tax issues. For example, if you had a UK company with Irish employees that were typically based in the UK, but because of COVID, moved back to Ireland and were working in Ireland for the UK company, that can trigger a permanent establishment tax presence, a corporate tax presence for the UK company in Ireland. And it can also trigger payroll tax obligations for the UK company in Ireland, and indeed income tax implications for those individuals. The flip of that is that if you had an Irish company with individuals that were stuck overseas, that could create an overseas tax establishment for the Irish company, which could have implications in terms of additional taxes at a higher rate on this deemed branch in a foreign jurisdiction. There could also be overseas payroll tax implications for the Irish company. So potentially lots of issues to consider. And tax residents of companies as well could be impacted, because if you had directors of, for example, the Irish company that were maybe in France, stuck in France, and board meetings were held in France for the Irish company, that could trigger a change, a migration in the tax residence of the Irish company to France. So all of those issues are potentially significant from a tax perspective, and because of that, the Irish Revenue and indeed various other revenue authorities and the OECD have essentially confirmed that if you've got these exceptional or temporary changes in location of individuals, or indeed where the board meetings are held, that those in themselves are unlikely to trigger any adverse income tax or personal tax consequences, or the creation of a permanent establishment for corporate tax purposes, or to trigger a migration of the tax residence of a company. So that's a very general statement, and you still need to look at individual countries. We know what the Irish position is, and Revenue have come out with some guidance on it, which is helpful, and it does put a lot of emphasis on retaining documentation. So if you do have potential issues that you think might be relieved because of the guidance from Revenue, it is critical that you do keep that evidence on file in terms of the fact pattern around it. Because the implications here can be significant. Just even looking on its own at, for example, the migration of residents. If you have an Irish company and if its tax residence happens to be deemed to have moved from Ireland to another jurisdiction, you can quite easily trigger a deemed disposal of all of the assets of the Irish company and potentially a very significant tax bill. So it is important to keep an eye on things like this and make sure if you do think you can avail of the relieving provisions, or if you think there might be a risk, that there is documentation on file to support the position. And the unknown again around this is, we know what the position is at the moment, and the guidance is all essentially presupposes that this is a fairly temporary state of being, but we're already in August, and there isn't any end line in sight at the moment. So what happens if this extends beyond that, or what if it doesn't and there is closure, if you like, around COVID, but the position continues? Is there then a future issue that might trigger because of habits that developed as a result of COVID? So there are some unknowns around. I think the message for the moment is, do keep documentation on file if things have changed that might give rise to an issue, but they are COVID related, to be able to document that on file. So very last slide is just around some other measures. Now, some of these are minority sport matters. So I'll start off with two of the minority sport ones, which is CFC legislation. So CFC, for those that don't know what it is where you've got an Irish company with subsidiaries that are in low tax jurisdictions. And essentially the profits of those low tax subsidiaries are driven by activities in Ireland. So it came in last year. So there was some publicity around it, and it came in as a result really of EU directives. But it is quite significant and it can be missed. So if you do have an Irish group and there is a concern around the position of low tax subsidiaries, don't ignore it. Anti-hybrids is a similar provision in terms of being new. It came in this year, and again, it's one that's quite easy to miss. It is minority sport. It's essentially around deductions that you might take in Ireland for an expense that isn't taxed on the other side, and because of a recharacterization of that income stream in the other jurisdiction. And interest paid by an Irish company tends to be a significant one there. Again, it can be easily missed, and you might think interest paid, for example, to the US couldn't possibly be caught by this, because US is known as a tax planning jurisdiction, but we have situations where interest has been paid by Ireland to the US and isn't taxed in the US because of US check the box elections and various other characteristics of the US regime. And that can be tricky to spot, because you may not know how it's taxed in the US. So just do be aware of the anti-hybrid legislation. It's only in now, so it isn't relevant for 2019 filings, but it is relevant for 2020. And now might be the time, if you're in a position like this, to see what payments are being made overseas, and if there's any concern around the anti-hybrid legislation, and to see is there anything you can do about it. Future changes to interest deductibility. This is a little bit more. This isn't a minority sport matter. It is typically for larger groups. It is a piece of legislation which has not yet come in, so it isn't yet in force, but it will come in, because again, it's on foot of an EU directive, so we have to bring in this legislation. And at the moment in Ireland, pretty benign rules around interest deductibility. Generally, interest is deductible. Even with transfer pricing, most interest tends to be deductible, subject to fairly limited considerations. The changes will mean that interest is broadly capped at 30% of EBITDA. So that is a very significant change from where we are today. It hasn't come in yet. As I say, it has to come in by 2024 latest. At the moment, it looks likely to come in 2022. So just to be aware of that in terms of any future modelling, if you are modelling full deductibility of interest in the future, well, from 2022 and even potentially 2021, that won't be the case. There is a de minimis that's available to Ireland, and it's expected that we will bring that in. So it may only impact on larger groups. The de minimis will be somewhere between 2 and 3 million, but it is a group test. So if you are in this space, as I say, it's something to watch out for. Finally, for me, transfer pricing. Transfer pricing is relevant to many more groups, certainly not a minority sport. The documentation requirements around transfer pricing have been increased, were increased in the Finance Act at the end of last year and is now live. So more onerous documentation requirements, often that will already be satisfied by what's been done overseas for the benefit of other jurisdictions, but there are now additional requirements in Ireland, and that's critical, because if you're a delinquent or deficient in that respect in Ireland, it isn't a full and complete return. So it's very important that the transfer pricing position in Ireland is documented as being compliant. It is also anticipated, and it's been flagged, which is waiting for a ministerial order, that transfer pricing, which at the moment doesn't apply to SMEs, will apply to enterprises that fall within that category, medium-sized enterprises in particular, from a particular date. So it will extend as the remit of TP beyond where it is at the moment. And indeed, last year, the remit of transfer pricing extended to other types of transactions, in particular non-trading transactions that previously would have been outside the ambit of transfer pricing. So loans that Irish companies made intra-group that weren't part of a treasury trade, they were never within the scope of transfer pricing. They are now. So there's a lot more activity and interest in the transfer pricing space, and people just need to be aware of that. So that's it from us. There's a lot in it. My slides at the end are really about things to watch out for. The main thrust and theme, obviously, of today's presentation is around the cash flow benefits of, in particular, losses in 2020 and the ability to carry that back. In some cases, it may not be merited. The losses may not be significant enough, but in other cases, they will be, and there's a significant cash flow benefit from putting an early claim in for those losses, then topping it up with the full claim at the time of the filing of the return. So we still have time for Q&A. I think there have been, Kim, a couple of questions that have come in.
Yeah. I suppose just before we jump into the Q&A, just to highlight that a copy of the slides and recording will be circulated to all attendees. So we have mentioned, I suppose, legislation, guidance, made reference throughout the last couple of moments. So there is, I suppose, a useful links there that we will circulate, will be provided, and also just a sample there that's linked back to what you heard from Sarah earlier on the loss relief measures. So yeah, there's a couple of questions here, and Sarah, they're mainly for yourself. In relation to the loss relief measure. So I'll pass over to you if that's okay, because they're picking up on just the topic that you covered. Thanks.
Yeah, no problem. So the first question is, if 2019 was the first year of corporate tax liability, no PT has been paid, is the company better off waiting to claim 100% of the 2020 loss under the usual loss offset rules? So it probably depends on the quantum of the losses and the tax liability accruing in 2019. But I think there potentially is a benefit from availing of the 3960 kind of early loss relief. So in the absence of claiming it, the full tax for 2019 will be due to be paid by the 23rd of September 2020. And if you didn't claim that early relief, you could only claim the 2020 losses when that tax return is filed, which the deadline for that is the 23rd of September 2021. So you'd have a year of having tax sitting there, paid over to revenue, without accessing any of those 2020 losses. Whereas under the new provisions, you can actually claim 50% of them once they fall within that COVID 10-month period, and reduce the tax that has been paid to revenue in respect of 2019 in September 2020. So there potentially is benefit. I think you probably need to map out the figures and see, the quantum of the relief, and is it worthwhile. But in principle, I think there probably is scope to avail of the cash flow benefit in that scenario. The second question is, if 50% of the loss generated in 2020 is greater than the profits in 2019, can it be carried back against previous years under this relief? No. So the way the Irish loss provisions work is you can only ever go back 1 year. So if you've losses accruing in a 12-month period, you can bring them back for an equal 12-month period. If there's any excess thereafter, they're carried forward and available for profits accruing within the same trade as that in which they're generated, unless, of course, you're in a group and there may be an ability to do group relief claims to mitigate tax in other group companies in the same period as that in which they're generated. But you can only ever go back 1 year. it typically is 1 year, assuming the losses are generated in a 12-month period. If, for example, the losses were in a shorter period, you could only go back to an equivalent shorter period in terms of the carryback. So there are kind of a few nuances where you have periods that aren't 12 months. But yeah, you only go back to the equivalent kind of corresponding period, and that's it.
Thanks, Sarah, for that.
Kim and Peter, I think you've got off light. There's nothing so
indeed,
far.
we've got off very lightly.
Yeah.
Great.
Until next time.
If there are any other questions people have later on reflection, thinking about these slides or just looking through the numbers for 2020, please don't hesitate, obviously, to reach out to your usual Grant Thornton contact. We're nicely within time. So as Kim says, hopefully see some of you at our future webinars in early September. And indeed, we have a private client one, I think, later this week. So webinars, a lot more of them than I think we've ever seen before. But look, thanks a million to everybody for attending and for participation in the Q&A. And yeah, look forward to seeing you at a future webinar. So thanks again.